Welcome to our monthly strategy update. My name is Keith Duran. I'm the Senior Vice President of Business Development for the firm. I'm joined by Jim Warner, who's the Head of Research and Co-Portfolio Manager. We'd like to thank you for spending this time with us today. These calls are designed to keep you up to date with what we see in the economy, but also to keep you informed about what and why we own the securities that we do. So it has been there's been a lot of volatility in the market. Jim and I were just kind of discussing that. We've had a 3-week long sell-off of growth and pivot to value. We've got a Monday global sell-off, a boost in the ag. So this should be an interesting call. I know Jim's going to talk directly about some of the volatility that we've seen. So before I just hand it over to Jim, we encourage you to ask questions. On your screen at the bottom, there is a Q&A button. So please just ask away during the presentation if something pops into mind, and we'll be sure to address those after the presentation. Without further hesitation, I'll turn it over to Jim.
Okay, great. Thank you, Keith, and thank you everybody for joining us today. Let me share my screen right here, as I normally do, and we'll walk through our latest thoughts. So basically, the title of this webinar is "Are the Worst Fears Coming True?" And as we have talked, if you've been a frequent listener to this webinar, you know that basically we've been really focused on this chart, which is the Fed funds effective rate minus the core PCE or inflation rate. And what you can see is that monetary policy and interest rates have been very, very tight and very restrictive. And the last time we've seen it this tight and this restrictive was right before the great financial crisis and right before the dot-com crash. So the worst fear here is that the Fed is too late to ease. And of course, our worry has been that these high interest rates, we've not seen the full economic impact from them. And therefore, we could see, businesses lay off workers to protect profits. Consumers are obviously dealing with higher interest rates, but overall, we could see the economy succumb to recession. And really, the market volatility of the beginning of this week and the end of last week was really subject to this new fear of a higher risk of a recession and this fear that the Fed is too late to ease. So what we're going to spend a lot of time on today is talking about this pullbacks in general, and how we're reacting to them. So I think the way we have to think about this pullback is in 2 phases. The first phase really started on July 10th when NVIDIA rolled over and it caused all the other semiconductor stocks to roll over with them. Clearly, we had seen an enormous run-up year to date in NVIDIA and all other chip stocks. Whether it was buyer exhaustion, there was some negative news out on NVIDIA itself. But principally what you see here is a very technical trade. The AI trade was super crowded. Everybody owned these names. There was just a lot of, it was very, very stretched. Valuations were stretched, et cetera. And so you saw basically the NASDAQ roll over first. This then filtered into the S&P about 6 days later. But essentially, what you've seen is a pullback from the winners this year, and that's principally these AI stocks. And you can see the NASDAQ chart on the right. As Keith alluded to in his introduction, this had the effect of growth stocks in general underperforming value, which is actually fairly rare. We've seen that, this in this chart down on the right, that value really has not kept up relative to growth all year long and really for the last year and a half. But we've had a very, very dramatic correction in that. But the point that I really want to make here is that this first phase of this pullback was not driven by economic concerns. It was driven by crowdedness, essentially buyer exhaustion, and that sort of thing. And that's all, by the way, totally perfectly normal. We see pullbacks all the time. I'm going to go into some detail on that, but to see something run up really quick and then pull back, it happens all the time. And it just so happens that This time around, it was AI. Now, the second phase of this pullback really started on Thursday, and this one's a little scarier. On Thursday, we received the ISM manufacturing PMIs, and that's obviously measures whether the manufacturing sector in this economy is growing or not. And it missed pretty badly. You can see that it actually dropped. I don't actually show it here, but a subcomponent measures employment within the manufacturing industry, and that actually really missed. So it came in at 43.9 versus an expectation of 49.2. What this means is that employment in the manufacturing sector is shrinking much faster than people think. And you can just sort of see how dramatic that fall off was in July. Follow that up with, on Friday morning, we got the non-farm payrolls report. And that basically confirmed that the labor market is weakening. Now, it showed that we only added 114,000 jobs in July versus an estimate of 175,000. So, okay, you look at this graph and you say, that's bad. That's one of the worst prints we've seen in the last year. Not as bad as April, but when you put those two data points together, a lot of people are sort of starting to extrapolate that maybe we need to be concerned that the labor market is weakening faster than expected. And maybe we need to be concerned that the Fed is making a mistake by not cutting sooner. And maybe this means that recession is more likely than before. So that's really what a lot of the fear that has been injected into this market on Monday. Now, Monday got helped out, and I'll show this a little bit later, but it got helped out by the services index, and we'll go into that in a bit. But the other thing we can't forget, in connection with these first and second phases of this pullback, is that this is seasonally the time of year when a lot of investors take down their gross exposures. They sell down their stocks because they're going on vacation in August. So we're in this really weird seasonal period that is generally not good for the market. And you couple that with all these other things going on, it was really pretty ripe opportunity for a pullback. Just to go into this a bit, now these are numbers as of through Monday. So obviously we've had a little bit of a rally here yesterday and today. I'll go into that in a minute, but basically these are all numbers as of, maybe that was the bottom we put in Monday, maybe not. But as of that date, the NASDAQ had sold off 13% from its prior high. And I put this little table together on the right because I think it's just, it's emblematic of just how dramatic this pullback has been. So we entered into, before September or July 10th, which I noted was the peak of that NASDAQ, the NASDAQ was up 23% for the year. And then since then has pulled back 13%, which is pretty dramatic, right? The S&P, it's been a little bit less dramatic, but it too is very influenced by the AI trade. I mean, NVIDIA was roughly 6.5% of the S&P 500 going into July 10th. So you see the influence here as it's traded off 8% since being up 18%. But where you found some protection though was being in the equal weight index, or basically anything that wasn't AI actually is held in there pretty well until basically, Thursday, Friday, and Monday. But up until that point, you saw basically all the other non-AI stocks hang in there pretty well. And then the really great thing here is, and that I pointed this out now, for a number of different months, that bonds are actually doing their job as a hedge. This is terrific for portfolios. If you remember back to 2022, everything went down, including bonds. There was very few places, if any, to hide. Now we actually have a place to hide. So if you're very concerned about where the direction of the economy, you can be in bonds. You can get a nice yield, and you actually may see bond prices increase if things get worse. So the aggregate bond index actually was flat going into this pullback and is now up 3% for the year, or 3% since then. So, and therefore 3% for the year. So that's actually very, very encouraging. But the key point is that what I also want to make on this slide is that pullbacks are very common. They happen every year, and they offer generally great buying opportunities, unless there's a fundamental change in the economy. And that unless is what we're really focused on right now, and understanding how much worse can the economy get, because that will drive how much lower the market goes and where you want to actually start stepping in and buying. So where we sit here today after this pullback is that the S&P is up roughly around 9-10%. The NASDAQ is up about the same. The equal weight sort of caught up and is up about around 7%. Same with the Dow Jones. So then let's, because we're now super focused on the labor market, let's go in and into detail and figure out, talk about it a bit. I'm just putting this slide back up, this chart back up, which I had in the prior couple slides ago. This is the non-farm payrolls chart and the additions each month. And that 114 obviously is what's gotten everybody concerned, and they're all, sort of drawing a trend line down to the right. But what if this is just a blip like it was in April? What if in fact in August we see, 180,000 jobs? What then? And so, what's really important in pullbacks is not to overreact. And you're going to hear this from me over and over and over again today, is that you need to stay very disciplined in how you exit things, how you raise cash, and then how you add that back and take risk. But right now, we don't know if this is an actual trend. This could just be a blip, but it clearly wasn't a very good number, and it caused a lot of consternation in the market. The one negative thing I'd point out about payrolls, however, is that they seem to be repeatedly overreported. So I went back and I looked at the last 6 months of reports, of payroll reports. And so this number in the reported column would match up to the previous chart I just showed you. And then and each time we get a new labor report, there's an opportunity for the Bureau of Labor Statistics to revise the prior number. Well, what you can see in this middle, this sort of second to the right column, the revised column, is that 5 out of the last 6 months, the payroll reported number has been revised down, and not by a little bit, on average by 19%. So, it's fair to think about this 114,000 number, and maybe it's closer to 90,000, if once they revise the number. So this is going to be really important to watch. But, clearly, even the BLS has had difficulty reporting correct numbers each month. So we almost have a lag before we really know what's going on in the economy. But by and large, the labor market is definitely weaker than the typical reports that we've seen. The other thing we know, thanks to the BLS, is that the unemployed ranks are growing. The average number of unemployed workers now in this country is about 7.2 million, which is well up from the average in 2019 of 6.0 million. So there's a lot more unemployed folks. And there's now fewer job openings per unemployed worker. So that's a real indication of a weaker labor market. And what I did in this graph here was I extrapolated, because there's a lag in some of the data, but basically the direction that we're heading now is what is below 1 job opening per unemployed worker. And that's pretty weak. And so that's something that we're going to need to watch out for. So to simplify kind of what the paths forward are, there's really 2. We've been talking, and I probably should have reversed the order of these bullet points, but basically we've been in a world where the market has assumed we're going to have a soft landing. And that's basically been fueled by sort of a gradual weakening of the labor market and a gradual decline in inflation. Well, these weak labor reports sort of call that into question. So the assumption has been that we're going to have, that a soft landing is good for stocks. It's going to allow the Fed to sort of gradually cut rates, and we're going to end up getting through this okay. Bonds probably are going to not see great performance, but they still have pretty decent yields. And that gradual rate cut will help them, but you wouldn't see really fantastic returns there. However, there's another more potentially increasingly likely scenario of a recession. And if this labor weakness really does transmit through and creates weaker consumer spending, because that's what we're really worried about, right? We're worried that consumption starts to really decline, which we have not seen yet, of course. But what we worry about in this recessionary scenario is that the labor market continues to deteriorate, the Fed does not cut rates aggressively enough, and the economy enters a recession. Obviously, that's probably bad for stocks, but high-quality bonds could fare well. So that's kind of the 2 scenarios that we're looking at right now. And I would say that the market is now having to wrestle with the fact that there's a little more likelihood that we're going to hit the recession scenario at some point over the next year than the soft landing scenario. So let's talk a little bit about pullbacks. So we've told you, many, many times that pullbacks happen every single year. And this is an interesting chart that we found from JP Morgan that basically, it's probably hard for you to read right now, but when we distribute the report, you can see more clearly that every single year, almost without fail, there's at least, a high single-digit decline in the market from peak to trough. And sometimes you get, obviously, crises where it's a lot bigger drop. But on average, throughout time, including crises, the market corrections occur. Typically, there's a market correction of around 14% every year, at least once. That's on average. Of course, some years it's less, some years it's more. But on average, you can basically figure that you're going to have a 14% correction. Obviously, one thing that you want to do as an investor is buy those dips. So obviously, we want to gauge just how far the market's going to pull back before you make those dip purchases. But right now, where we sit is from the peak. The Nasdaq is down roughly 13-ish%. The S&P is down high single digits from its peak. So we're getting into that sort of area where you want to start thinking about buying dips. The key is, though, to be disciplined. And I'll tell you one of the reasons why one of the key issues driving our discipline right now. But one thing, obviously, what you want to do is you want to raise cash. And we've done that recently by exiting some of the riskier names in the portfolio. It's really important that you're not afraid to sell. There's a lot of people that when things get volatile, they do nothing. Oftentimes, that can be the right answer, but when a new question is asked, such as, is the labor market deteriorating so much that a recession is more likely, you need to be not afraid to sell, to raise cash, and then wait until you find outstanding value, because there's always outstanding value to be had when you have these pullbacks. What we don't believe is that this is some sort of a crisis. This isn't, obviously the COVID pandemic, where the market went down 34%. The global financial crisis and the dot-com bust were obviously two very scary years. We don't think that we're, anywhere as close to that. The financial system is highly capitalized. There's lots of home equity. Yes, there's some bubbly stocks, as we've seen in this pullback, that have gotten hurt, but they're not all bubbly. There's obviously no pandemic and shutdowns of economies. So in general, we feel pretty confident that this is not going to lead to some crisis. Obviously, the problem with crises is they usually come out of the thin blue air and are a surprise. But as far as our crystal ball is telling us, there's no crisis on the horizon. And so if we're still in this kind of bull market cycle, and we're getting kind of a typical bull market pullback, it's important to kind of gauge, what does this really mean? And what's really interesting about this current cycle, I looked at basically the last 3 cycles, one post-financial crisis, one post-pandemic, and then kind of the current cycle that we're in. If you look at for pullbacks greater than 5%, so peak to trough, at least 5% pullback, there's been 5 in this current cycle. And there was 5 in the previous 2, which is pretty interesting. The average drawdown has been around 8% on the S&P 500. We're around 8% right now on the S&P 500. So this current pullback that we're experiencing, for whatever the drivers are, is actually seeming fairly normal. And so that's one thing to point out right now. So I've been doom and gloom here for several slides. Let me give you some good news. The good news is that the services sector, which is way bigger than the manufacturing sector, is hanging in there. We got on Monday morning the PMI and their employment sub-index, and both beat expectations in July. The good sign, this is a good sign, and it's a great sign that the service sector is still growing and still adding jobs. You can even see on the PMI employment chart on the right that that 51.1 print was much higher than the previous months and is indicative of actual growth in jobs. So again, that's a piece of good news that we can take with us, that offsets some of the negativity that I expressed earlier about the labor market. The other good news is that interest rates have come down dramatically over the last week. And you can see from the US 2-year Treasury yield and the 10-year Treasury yield that that we basically pulled back pretty dramatically to lows that we haven't really seen for over the last year. And this is obviously very supportive of the labor market and consumer spending. It's supportive and provides a tailwind for corporate earnings, which is super important for, what the expectations are of earnings going forward. And it's great for consumers that have debt that's variable rate. So, there is some good news out there to express. So how does this all relate to our portfolio, our strategy, how we're thinking about reacting to this pullback? Well, right now we are essentially in a risk-off market, and I'd say the one scary thing that happened on Monday was that we saw the VIX spike to 66. And this chart on the right here goes back all the way to 2019. But basically, that first big spike you see in the chart around spring of 2020 was obviously related to the pandemic. And then we've just had some very choppy periods dealing with high inflation and that sort of thing. But for the last year, we've been in a wonderful risk-on market, very low volatility, which is great for our stocks. And that's why it's one of the reasons why you've seen people take risk and chase these AI names up. But this spike on Monday was pretty unique. It was not just driven by the AI pullback and the labor market weakness. It was also a function of a very, very crowded Japanese yen carry trade that was unwinding over the weekend. As many of you probably saw, the Japanese market took a header on Monday as a consequence of essentially a big unwind that occurred on a popular trade. What we are concerned about is that when things like that happen, it can tend to blow up hedge funds that are involved in those trades, or it can have other effects on levered business models. And so that elevated and dramatically elevated volatility can sometimes cause some sort of a black swan event, like think long-term capital management, where somebody got out over the ski tips and they can't handle the volatility. So the next couple of days or so, we're just looking around and making sure before we start adding to this dip that something doesn't break. And because this is the kind of event that breaks things. So, and ultimately, time will tell over the next day or two whether anything will break, but that's really kind of front and foremost in our mind. We've already seen the VIX, by the way, kind of come back down closer towards that 20 level. The risk taking in the general view is that under 20 is where you want to be to take risk. And we're starting to see the VIX come back down towards that. So that's a positive sign, a very positive sign. But it's really important to be patient and just make sure that nothing breaks in the very short term. So what have we done? Well, obviously, our first and foremost mission is to protect irreplaceable wealth. And so we sold some riskier stocks to raise cash. We're now sitting very flush with cash in our kind of our main moderate global vigilance models. And we're monitoring the market for stability. And we are, planning on adding back stocks and probably bonds as this market kind of just cools its jets a little bit. So timing is always a big question. Like, when do you do it? Obviously, for more aggressive investors, you can start to add now. But for our typical investor, it's usually important to kind of just give it a little bit, make sure that there's more stability. There's also not a great reason to be adding risk at this time of the year. As I mentioned, there's a lot of investors that are on vacation. They're in wait and see mode. Obviously, there's not a lot of people out there willing to take a ton of risk right now. So there's not a huge incentive to aggressively go after this dip. We also have a number of catalysts coming up this month that could be very important in determining the direction of this market. This is just a list of a few of them, but On the 14th, we get CPI. We think that's, inflation is X housing is below target. So we don't think that that's really an issue. But on the next day, the 15th, we get retail sales ex auto. This is really important. So if we're really worried about recession, retail sales need to hang in there. So if we get a weak retail sales print, this market could head lower. Unemployment claims are every Thursday. They are now super important for investors to watch, as this will give us a more real-time read on the labor market and its health. Then on the 28th, we get NVIDIA's earnings. I don't have any clue whether or not it's going to go up or down, but I have a feeling it's going to be very volatile, and that will cause a lot of the market to be volatile. And so, we're just going to have to wait and see where NVIDIA is to know whether you add into that event or you get out of the way. But that's, I think, going to be a pretty volatile day in the market. And then on the 30th, we get personal income and spending. And so, just like retail sales are super important, this is going to be another indicator just like that on whether the consumer is basically getting tapped out. Now, we know, based on the earnings calls that we've listened to over the last couple of weeks, that a number of businesses have mentioned, like McDonald's and others, that the low-income consumer is really tapped out and is pulling back on purchases. So although that represents a fairly small percentage of the overall spending in this economy, obviously any sort of migration upward into the middle class will have certainly an effect. So there's a lot going on at a time when there's a lot of investors not in front of their screens. So we would expect sort of heightened volatility over the next few weeks. That said, some of the best trades I've ever made are buying things in the last week of August before everybody comes back to their desk in September. And so there's going to be probably some very interesting buying opportunities forthcoming. I mentioned earlier that bonds are back, and this is, if you're not comfortable, adding to your equities, bonds are now an actual viable option for investor portfolios, and they will do fine, even if we go towards a recession. And when I'm talking bonds, I'm not talking about high yield. I'm talking about mortgage-backed securities and investment-grade bonds and treasuries and that sort of thing. But it's very, what we have been doing for the last month or so is adding duration or convexity, sensitivity to interest rates, longer-term interest rates to portfolios. And that actually turned out to be a terrific hedge over the course of the last couple of weeks. I can't have a presentation without talking about the presidential election. There's a lot has changed in the last 4 weeks since we last spoke. Obviously, it's Trump v. Harris. We've had an assassination attempt, a Republican convention, Harris replaces Biden. I mean, there's a lot going on in the last few weeks. As far as the polls are concerned, it does look like Harris has pulled a lot closer, making it pretty much a toss-up, at least on the national polling level. And the betting markets actually still have Donald Trump favored and favored actually by more than he was pre-debate. So, who knows? It's going to be a wild next 3 months. I can't believe it's only 3 months until the election. But one of the difficult things that we don't know, and I'll address that here in terms of one of my considerations going forward, is we really don't have any idea what the Harris administration's policies will look like. I don't know if it's fair to extrapolate from the Biden policies, or if it's going to look very different. We kind of have an idea of what the Trump policies will look like, partly because he's already been president once. But even there, too, there are some wild cards. So, we're going to be spending a lot of time kind of, really kind of, sharpening our pencils on those two candidates' policies as they become available. But just to touch on AI, for example, AI is still real. Now, there's been part of the pullback in AI stocks recently has been that folks are trying to figure out, like, okay, what of all the billions and billions of dollars of spend that's going into generative AI, what's the return on that spend? That's sort of the big question for the big tech stocks that are spending on those big data centers. And then as you go down and you look at sort of other, the application of AI in industry, people are really trying to figure out, investors are trying to figure out just how much money do you have to spend and what's the return going to be? And we don't really know just yet. Um, but right now, as companies figure it out and communicate that to the street, we'll be able to make a better assessment of where you start trying to nibble at these names. Now, I think some of these names have pulled back so dramatically that it's probably, sooner rather than later that we'll start nibbling at them. But you do have to be concerned that, you're trying to catch a falling knife and you might be a little early. As I mentioned, bonds are obviously the real deal. So we're looking hard at potentially adding bond exposure there to a lot of portfolios. And then the other two, I think, things that are outstanding, obviously the consumer, are they cracking? And that's related to the labor market, of course. We've talked about how important that is going forward. But also, how aggressive is the Fed going to be? The market, after the last couple of days, is now expecting around four-ish, 4.5-ish, 25 basis point cuts this year, which is, I think, way too much. And certainly, if you listen to the Fed speak, there's, I mean, I think you're going to get probably what they're telling you, which is 25 bips in September, and then they'll wait and see. So I don't think, I think the currency market or the treasury markets have gotten a little ahead of themselves in the short run. But, how aggressive are they going to be? If we start to see the labor market really fall apart, are we going to see a 50 basis point rate cut? It's hard to tell. Anybody who's been listening to me give these webinars knows that I have not the highest degree of confidence in the Fed's timeliness on reacting. But that being said, we're just going to have to wait and see and try not to make too many bets based on, what we think the short-term markets are going to do. Now, let me finish on this positive note, and then we can address your questions, because I'm sure there are a bunch. I've shown this before. There are $6+ trillion sitting in money markets. Now, that's good news for people who want to buy dips. That's a lot of money just sitting on the sidelines. And if the economy rolls over, rates are going to come down. You're not going to be earning your 5.25%. You're going to have to move out the bond, the interest rate curve and buy bonds. If the economy stabilizes and we see gradual cutting of rates, you're still going to earn less on your money markets. You may want to try to find a home in stocks. But the point is that we've never seen this much money just sitting on the sidelines waiting to buy dips. So that's a very encouraging, I think, aspect of the current situation, that even if things sort of start to fall apart economically, there's a lot of folks out there with a lot of money that are going to start to look through to the other side of the recession, because that's what investors do. Is, once we see something, we start to look through towards the next cycle starting up. So this is, I think, an encouraging thing. So let me stop there, Keith, and let's just take a few questions.
Sure. So let's just take them as they kind of came in. So what maturity bonds would be the most advantageous?
Well, I think you want to basically have you want to gradually move out of the short end of the curve into the longer end of the curve. So whether that's buying, a typical investment grade bond fund would have kind of a 7-ish year duration, that's fine. We have some of that exposure. We also have exposure to even longer duration. If you're really interested, there's some incredible opportunities way out the curve that we've never seen before in our lifetimes. And so I think you basically want to just gradually move out of the short end of the curve and, buy a whole bunch of, durations so that you can take advantage of lower rates if and when they come.
Thanks. So Bob asks, with the TCJA of 2017 expiring, how do you see the effect if nothing gets done in Congress?
Well, something's going to have to get done. I just don't know what it's going to look like, and it's going to depend a lot on this election. I can't imagine that either side of the aisle is going to want to see taxes increase for the middle class. So that's what gives me at least the confidence to say that something's going to get done. But I mean, who knows how this election, if it's a red wave, it's going to look way different than if it's a, a mixed House versus Senate. So, it's anybody's guess, but you correctly point out that it is among the most important questions to understand for 2025 and beyond.
Okay. So Mike is asking about the ISM graph for the past year, shows a lot of ups and downs. So why does this stat show such fluctuation? That is, what's the difference in July, I think from a few months in the past?
Well, I mean, it's a survey, and surveys have their own, issues. I look at these things as being more directional than focusing on a single data point. But not that the market doesn't initially at least react to single data points. But I've gone through, and there's only so much you can learn for how they collect the data. Um, and obviously they also put in seasonal adjustments and that sort of thing. But I think directionally speaking, manufacturing has been shrinking for the last 18 to 24 months. And services has been basically hanging in there. So, and that's, essentially the big takeaway that I would grasp from that graph.
Good. Can you expand on the SAM indicator that we've all been hearing so much about?
I don't know what you mean by SAM indicator.
I think it's I think it's some sort of an indicator that shows or when it's able to predict a recession if some stat they look at. So you've never heard of it. I had to
I don't
I
look at
looked
it.
it up.
I look at underlying data, I look at leading indicators, I look at all this, but let's just the a lot of people have made a lot of bad investment decisions looking at predictive recession indicators. If look at 2023, everybody was predicting a recession tomorrow, right? Or the next week. And all these recession indicators were saying, oh, it's imminent, all this stuff. I don't I don't find any value in any of those indicators. What I find value in is actually dissecting the data myself. And to me right now, the most important thing is the labor market. If the labor market cracks, then we're going to have a big problem on our hands. But so far it's not strong, but it's hanging in there. But that's why I show you the individual data points as opposed to relying on, some indicator that somebody puts together.
Yeah. So listen, we only have two left. Has the Fed overstated what real rates should be?
Uh, well, they haven't stated really anything about real rates. I know I mean, I started with that graph, right, which is the Fed funds rate minus the inflation rate. And what that would essentially tell you is that real rates are way too high. And so, if you're just looking at that, for example, yeah, I mean, I think they've definitely overstated. I mean, I think we were way too tight. But clearly, if you listen to them, they don't think they're too tight. You're starting to hear whiffs of some of the Fed committee members say, we need to, potentially cut rates. But that's really recent, and it's really only a function of the market volatility we saw on Monday. But no, I think that the biggest risk is and continues to be that the Fed does not see the weakness in the economy soon enough and is then too late to cut. So yes, that's the single biggest risk, and that's our greatest worry, quite honestly. But yeah, I mean, the inflation, as I've said, is below target. We strip out housing, which we know what direction that's going now. And so, it's not an inflation issue. Now it's a full employment issue, and we're seeing that go the wrong direction. So, we'll see, but they've been holding their cards pretty close to their vest. What my big worry is. We'll see if they surprise me, hopefully. But September is the next big mark. In 1 month, we will get maybe 25 basis points. I kind of doubt we're going to get 50, but it would be a really bad indicator. And to your point, It would really show that they've overstated real rates, if they do nothing.
Right.
And by the way, I should add, one of the first things that they're going to have to do, and they'll maybe do this with the 25 bip rate cut, is to eliminate quantitative tightening. And by the way, that would be great for our mortgage-backed security positions, which have really been kind of foiled by the Fed's unwinding of their balance sheet.
So there's actually two things, right? So a follow-up to that is that the Feds miss, like, won't a bigger cut make a difference? In other words, can't they play catch up quickly?
The market will freak out
Yeah.
if they're late and they have to go and they go, whoopsie, we got to do 50 or 75 bips. I think the market will freak out.
Yeah. And then in this presentation, you haven't talked at all about gold, silver, copper,
Yeah.
any of the commodities.
Yeah, so we're still quite bullish on gold for a variety of reasons, and so that remains in the portfolio. There's just really nothing to talk about today on that subject. Copper we have in some portfolios, not all. We are still long-term bullish on copper. It has had a tough go of it recently, largely because China remains as weak as it is, and it's a big consumer of it. But longer term, we think copper's got some real legs.
Awesome. Okay. I think that about does it. No other questions are popping in. So with that, Jim, thank you so much. A lot of stuff coming up here to digest, with these prints coming up through August. So with that, we will have this presentation available in the next couple of days once it goes through compliance, and we can send that out to you. If there's anything we can do to help, please feel free to reach out and contact us. Other than that, we'll say thank you, and we'll see you all next month.
Thank you.